Welcome to another presentation from SR Snodgrass as part of our ongoing podcast series. I'm Lenore Seifer, the Director of Human Resources, and today I'm speaking with Brendan Whalen, Audit and Assurance Principal.
Thanks, Lenore. I appreciate the opportunity to be back. It feels a bit more comfortable every time we come back to this setting. I think this is the third time we've had the opportunity to do this.
And I'm sure there'll be more as well, too.
I can't wait. Look forward to doing it.
So we really want to learn from you today, Brendan, because as I mentioned, you have been spending your time within that banking industry and knowing it inside and out. And as we know, in our ever-changing world, the banking world also has lots of changes within it as well, too, on a regular basis. And you are one of those people that helps our clients lead through those changes with certainty, as much as possible in an uncertain world, of course. Let's start with a little bit of an overview. I know it was first introduced quite a while ago, but can you give us a brief history on that?
Yeah, absolutely. So FDICIA, it stands for the Federal Deposit Insurance Corporation Improvement Act. This is a regulation that was introduced in the early 90s, really as a response to the savings and loans crisis that ensued from the 1980s into the mid-90s, where you saw about 1,600 failures of savings and loans. It was about a third of the savings and loans at that time failed. So this entire regulation was aimed at strengthening the banking environment and mitigating or reducing the negative impacts to bank failures.
Did it work?
It has, yes. It definitely did what it was intended and sought out to do. We see some evolutions now just because of growth in asset size, which I know we'll talk about in a little bit. But it most certainly did achieve its overall objective, although there's no immunity to bank failures. Bank failures will happen at certain points in time.
But it sounds like it helps to minimize that overall and any disruption.
Absolutely, yeah. The regulation really facilitated and achieved its goals through the early identification of problem management of financial institutions.
Now, when we talk about implementing measures, such as what FDICIA did, to help strengthen banks overall, I'm sure that came at a cost in many different ways to the banks.
It absolutely did, yep. And that's one of the things they're setting out to achieve with some of the proposed changes that were issued in July. And really, when you take a step back and think about the way that FDICIA works and how this regulatory oversight plays out in real terms, it's all based on asset size thresholds. So right now, the way that this standard is written, there are basically three tiers to compliance with FDICIA. It's those banks that are over $500 million in assets, those banks that are over $1 billion in assets, and those banks that are over $3 billion in assets. So there's different compliance and tier requirements that go along with a bank simply based on its asset size. At the lower tier, those banks that are in the $500 million to $1 billion asset range, there's the requirement to remit your audited financial statements to the FDIC on an annual basis. You're also required to remit, as part of that packet, a management report that really just confirms management's responsibilities for and adherence to certain laws and regulations. That would likely be the least costly tier of that threshold. The next threshold that you can migrate or graduate into is that $1 billion threshold. And there is a large step up in compliance requirements, both from the internal and the external audit services, and it requires really a cultural change, I'll say, and it requires that internal controls over financial reporting, and it requires management to attest to the effectiveness over their internal controls over financial reporting. And at that top end, that $3 billion range, that really just speaks more to the composition of certain audit committee members and certain requirements of those audit committee members. So all of that is now being revisited to determine what is the most appropriate and what is the best ability to reduce compliance costs and reduce burden of those institutions in some of those asset size ranges.
So what I'm hearing you say then is that when FDICIA was first implemented back in the early 90s, that the asset size of $500 million, $1 billion, and $3 billion, it sounds like you're saying that that's kind of what's changing here. That's really the bulk of what the most recent changes were proposed in July.
That is, and I'll make one clarification. So when this regulation was adopted in the early 90s, that $1 billion threshold really didn't exist. The ICFR, the Internal Controls Over Financial Reporting, that component of it wasn't introduced until 2005.
Okay.
And if we think about what happened in the early 2000s, the Enron scandal, a lot of big headline collapses, and then the introduction to Sarbanes-Oxley. And that introduction of Sarbanes-Oxley also led to the internal controls over financial reporting audits for banks under FDICIA that was adopted soon after the introduction of Sarbanes-Oxley. So really, if you think about it, this entire standard or set of regulations is based on mistakes, errors made by those who preceded us today in the financial solvency of those financial institutions.
Okay, so you're mentioning about the changes that have been proposed recently, this past July. Let's talk about, can you share with us what those changes are?
Yeah, absolutely. So, in July, the FDIC had put out a proposal that was unanimously supported to modernize and update its asset threshold requirements. So that $500 million, that billion, and that $3 billion mark that we had just previously discussed. So what they're aiming to do is take that $500 million benchmark, that threshold, and increase that to $1 billion. So anything that would have been required under the $500 million threshold now really just moves up in size or threshold compliance size to that $1 billion asset size threshold. The next tier that they're really trying to target would be that 1 billion tier and that 3 billion tier and combine them. So that what is now required for a bank that is $1 billion and 3 billion, they will merge both of those requirements together and move that asset size threshold to $5 billion in assets. So it's a major reduction in burden, particularly for those banks that are between the $1 billion and $5 billion asset range right now. Really because they would not have to have an audit of their internal controls over financial reporting, and they would not have to have that management attestation that goes along with that. So there are a lot of banks that are celebrating this, and I do think it's a really good thing for community institutions to have this reduction in overall burden of compliance. Really, when you think about it, it's aimed at having heightened levels of requirement for those institutions that are going to provide the most pervasive risk. And as we've just grown and the economy has gotten bigger, those banks that are in that $1 billion to $5 billion, they serve their local communities. They don't provide a pervasive risk to the financial institution system or really the FDIC's deposit fund.
That makes a lot of sense, and it sounds like it's good news for them that they are now not having to focus on those regulatory requirements of FDICIA then at an earlier stage. And it also sounds like it's simplifying it too by combining some of those asset thresholds together.
Yeah, it is. I think that's probably not the same, garnering the same level of focus. That $3 billion asset size, it is silly to me. If you add that extra tier in there. But overall, that's not the point of focus. I think it's really that $500 million and that $1 billion asset size thresholds that many are focusing on. In all honesty, that $3 billion asset size threshold was largely forgotten as it relates to compliance here, because it's really just one compliance as opposed to the big leaps when you're going from 500 million to $1 billion. So the other big reprieve here, and what we're really seeing as well, is there's also a leap when you go from under $500 million in assets to over $500 million in assets. And that's largely driven by some of the independence requirements that go along with this. So when you're under $500 million in assets and you make that jump to $500 million, well, now you go from being required to be compliant with what's considered the AICPA independence requirements to the SEC's independence requirements. That is a big distinction, as the SEC independence requirements are far more rigorous than the AICPA's independence requirements. And the big change there, if you're using a firm for multiple services, some are permissible under the AICPA standards, and under the SEC standards, they are not permissible. So you have to start making vendor decisions, and which can just impact workflow and relationships with management and their third-party vendors. And another big change that occurs is often those banks that are under $500 million in assets, the audit firm or the CPA firm who's doing the audit will also draft the financial statements for those institutions. That goes away. You're no longer under the SEC independent standards permitted to have your financial statements drafted by the audit firm. It becomes an independence issue. So taking that away from the CPA firm, requiring that to be done by management, is just more time on management. And right now, talent acquisition and retention at many of our clients is a challenge. You see a lot of CFOs reaching retirement age, or someone self-selecting out to work somewhere else, and not having the ability to replace that talent quickly, or maybe even at all, just places some undue burden on management, and then their ability to say, hey, you also have to do this because you've reached an asset size threshold that's somewhat arbitrary.
So when I hear you talk about that piece of it, and we had mentioned that, largely it's a celebratory type of announcement that was made, likelihood of this happening and going through?
I would fully expect this change to take place. So this proposal was issued or published in mid-July. There's a 60-day comment period that's open. So in the middle of September, I would expect that we have a direction that our clients can move towards as far as which way this is actually going to go. With the current administration in place and a focus on deregulation and reducing burdens and compliance costs, I would expect this to take place by the end of the year. So,
can you help us understand the timing of this? It sounds like things were introduced in July, but what would the implementation or effective date of this take place if it were to pass?
Yep. Yeah, great question. So, as you mentioned, proposal right now was published in July. There's a 60-day comment period. The effective date, as it is written in the proposal right now, is the first day of the calendar quarter following when this is adopted. So let's say in a hypothetical world, we come out of the proposal period and it's adopted in September. Well, that would mean that October 1st would be when this would be effective. However, this is done on a prospective basis for asset sizes. So really, if we're talking about compliance with FDICIA, those banks that are over that $1 billion threshold right now, they would still need to be compliant with those requirements as they stand and exist today, all the way through their audit cycle now. And once we get into the next year, that would all change for them. Same with those banks that are in the $500 million threshold, and same with those banks that are in the $3 billion threshold. So best case scenario is that for this specific proposal, it would be adopted in 2025, which would then mean that it becomes effective in 2026 on a prospective basis.
Gotcha. So it's not changing anything immediately necessarily because they've already met the requirements that they have to comply?
That's correct. And that's really because asset sizes in this standard or this regulation are all based on your asset size on the first day of your fiscal year. So, for those banks that are on a calendar year, it's January 1st. For those banks that are on an off-year end, like a September 30th, that would become October 1st. So there is some nuance there. You'd have to go through and evaluate, and that's going to be a bit institution-specific. But for those banks that are really hoping for this to take place in 2025 and relieve them of that burden immediately, I wouldn't expect that to happen. I'd expect to realize that benefit in future reporting periods.
So what is your recommendation to all of these financial institutions, all of these banks that may be affected by this?
Yep. Yeah, it's a great question. So the first recommendation is really to kind of take a step back. It's to understand how this impacts your specific situation. There's about 774 banks in that $500 million to $1 billion asset size threshold that could be positively impacted by this on a go-forward basis. A couple things you'd want to evaluate is some of those independence criteria. We mentioned earlier moving from the AICPA independent standards to the SEC independent standards are a lot more rigorous. Well, if you're a bank in that $500 million to $1 billion asset size threshold, they now revert back to the AICPA thresholds. So it would benefit you or that institution to just evaluate that, determine what your needs are, and how that best serves you.
Because it is still a change, even if it's less regulatory overall, it's still changing the processes and the way that you're operating.
Exactly, it absolutely is. Yep. And then for those banks that are in the $1 billion to $5 billion asset range, those banks are going to receive the biggest, I'll call it, windfall or gain from the reduction in compliance with this standard. So there's about 700 and I think it's 52 banks that are currently in that asset size threshold as estimated by the FDIC. So those banks, it's really just an evaluation of what your needs are. If you're rolling back the necessary ICFR, the internal controls over financial reporting requirements, it's understand that. But for those banks, there's a lot of SEC registrants as well. So you also want to evaluate what your standards or what your compliance requirements are under the PCAOB standards. So there are also separate regulations that exist for some of those banks that they may not get that reprieve because they're required under a different set of regulations to continue with this. But for those banks that aren't, it's just to be aware of that, and then what is your game plan going forward to be able to realize the benefit of some of these reductions in compliance requirements.
Are there any other benefits that banks would see from this?
I think there's one more benefit that's largely untalked about right now, and that's for those banks that are going to live in that world of $500 million to $1 billion in assets. So some of those institutions right now are HUD lenders, and for those banks, the requirement to have a HUD audit and a compliance audit in accordance with government standards is driven by the same asset size threshold. So this is something that's maybe not talked about as much because everyone's focusing on the other relief of compliance, but that would likely go away as well. So you're considered to be a large supervised lender for the HUD audit requirements once you eclipse the $500 million in assets. If that changes to $1 billion, you would also be relieved of that requirement to have a HUD audit on an annual basis. So that is actually a big win as well. For many of those banks, they might be originating 5 to 25 HUD loans a year, and that's not what's driving their requirements. Not the volume of loans they're producing. They could produce one loan under HUD standards and still have an audit requirement done. So it is a big cost saver for them as well, because that size of asset size threshold is going to be going up to $1 billion, consistent with the rest of the regulations.
So we heard about a lot of the changes, and they seem to really be positive for the banks. Are there any negatives involved?
Yeah, that's a really good question. I don't perceive there to be too many negatives as it relates to this specific proposal. I would say I would fully expect many of our clients and all institutions really to continue to employ safe and sound risk management practices. I don't think that goes away. I think there's still a common sense approach to managing risk. It's just having to adhere to all of these costly compliance requirements that are somewhat outdated, and that's actually what's aimed at being resolved here now by the FDIC.
And that's really, it seems, when we talk about the part about it being outdated, there's been so much growth and everything, and those numbers haven't changed.
Yeah, you're absolutely right. I mean, we're talking about 30 plus years since the initial introduction of this standard, and that $500 million asset threshold, which is that initial threshold to be introduced to compliance for this, has remained unchanged. So it does speak to the outdated nature. At adoption in the 90s, 75% of total assets were required to comply with this standard. I think I mentioned that previously. Even under these proposed changes, if they were to be adopted, you'd still have 89% of total assets under compliance requirements for this. So that really speaks to those banks that are $5 billion and above having the majority of assets that are going to create that pervasive risk to the FDIC's deposit fund, which is really what this is aimed at protecting.
So should banks be working with their auditors then to talk about the changes, get some things ready, and make sure that they have their clear game plan, or wait until the final rule is made?
Absolutely. Right now, on an annual basis, we help a number of clients that are going from that transition period under the current standards to be ready for that, especially that $1 billion threshold compliance requirement. For those banks that are going through that readiness process, depending on where your asset size threshold is at, you most certainly want to monitor this very, very closely. You want to have a detailed audit plan or a detailed game plan with your audit committee, with your external auditors, and with your internal auditors. If you're a bank that's gone over $1 billion in assets in 2025, so you're not required to comply with that because you were under $1 billion at January 1st, now you're over that at some time this year, you just want to make sure you understand the ramifications for when this becomes effective because you don't want to be surprised by that. So it's, again, if you're going through all the readiness process, you're going through maybe some parallel documentation with your internal and external auditors, keeping your audit committee apprised of the status. You just might want to take a wait-and-see approach for what ends up coming from this proposal in September. So, but more so for those banks, it's really understanding the effective date and how that impacts your bank on the go-forward basis.
Absolutely. Sounds like that's really kind of the critical piece to all of it, because initially it just sounds like great news. You don't have to do this now, but that date is critical.
Yep, you're absolutely right. So it is a big win, but it's, again, understanding the ramifications for your own institution and also the effective dates and how that does impact you going forward.
Brendan, it was great talking to you about this. I know it's a huge change within the accounting world and for specifically, obviously, banks. Can you remind us of those dates again?
Yeah, absolutely. So the initial proposal was made by the FDIC in mid-July. I believe it was July 17th. There was a 60-day comment period. So basically they're taking comments, hearing feedback from all stakeholders, and then making a decision as to whether or not they should proceed with the proposal as written, or if they need to revise it, or if they need to scrap it. Like I said earlier, I believe that after this 60-day comment period, this will be a proposal that moves forward as written. So we're looking at mid-September for a closing period for that comment period. And then after that, I would expect that the FDIC adopts this. So if they adopt it in September of 2025, shortly after the comment period ends, we'd be looking at an effective date of October 1st. And really, like I'd mentioned previously, the changes to this really would not take effect until we're outside of that annual cycle. It's something that each institution would have to evaluate just depending on their own set of circumstances, whether they're a calendar year-end reporting company, a fiscal year-end, whether they be a March 31st, a June 30th, or September 30th, and evaluate what that looks like for them. I'd highly recommend that those banks, management teams of those banks, have open discussions with their external auditors, with their internal auditors for determining what this means. I would highly encourage anyone watching this today to reach out to me. I'd be happy to answer any questions that anyone has.
So anyone watching the podcast, you have that open invitation to connect with us on LinkedIn, as well as to email Brendan with any questions, and he can help walk you through this process over the next few weeks to months.
I'd be happy to. Look forward to it.
Thanks for joining us today, Brendan.
Thanks, Lenore.
At SR Snodgrass, we're always growing. We have offices in Pittsburgh, Philadelphia, Ohio, and West Virginia. Whether you're entry level, senior level, or somewhere in between, we invite you to check us out. Go to our website at www.srsnodgrass.com, follow us on LinkedIn, and join us on our quest for the best.